Hey, welcome back. It's Nolan Mathias, and today we are discussing why variable rate mortgages, contrary to popular belief, are safer than fixed rate mortgages. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video, and leave me your questions and comments about variable versus fixed rates in the comment section below. I'll get to them right away. Okay, so let's get into it. Let's discuss why 5-year fixed mortgages are less safe than variable rate mortgages. And there's three major reasons why, and I'll start with this. The first is that 5-year fixed are really just adjustable rate mortgages. They just don't adjust as quickly as normal mortgages. If you look at it in the context of American mortgages, in the US, you can get a 15 or 30-year mortgage that has the same rate from start to finish without any penalties if you want to refinance or if you sell the property. That's significantly different than the Canadian style mortgage, which is a 5-year fixed. And what a lot of Americans look at when they see a 5-year fixed mortgage is they see a 5-year adjustable rate mortgage. And the reason why they see a 5-year adjustable rate mortgage is because every 5 years, your payment adjusts along with the interest rate that you pay. So in reality, that 5-year fixed is just an adjustable rate mortgage. It just has a set period of adjustments every 5 years rather than whenever the Bank of Canada moves interest rates. And the problem with that and the risk associated with that is that if interest rates start to rise in the middle of your 5-year term, you could end up renewing into a higher interest rate. And that could create what we call payment shock. That's when you renew your mortgage and your interest rate has gone from 1.5% to 3%, and all of a sudden as a result, your payment's gone up substantially without you expecting it, and therefore creating financial hardship. The difference with a variable rate mortgage is, yes, you'll still see your payments increase. However, you'll see them increase more gradually over time as the Bank of Canada increases interest rates. And as a result, you'll feel the pain in smaller amounts, and therefore you'll get more used to it quicker rather than it all happening overnight. And the key to getting a variable rate mortgage is to get one with adjustable payments. So one where as interest rates increase, your payments also increase so that you can feel that payment increase over time rather than all at once at the end of your term. And you also get the added benefit of the fact that as interest rates decrease, your payments will decrease as well. So as interest rates fluctuate, your payments will fluctuate in line with where interest rates are going and what's happening in the economy. And if your mortgage is set up in this way, you can rest assured that you aren't going to have a massive payment shock sometime throughout the life of your mortgage. Now, the second reason why variable rates are safer than fixed rates is because variable rates outperform fixed rates. It's just the reality of it. Very rarely will a fixed rate perform better than a variable rate. There's only been 3 times in basically the last 25 years where that has happened. And it is typically when you can get a fixed rate for a lower price than a variable rate. So normally variable rates run at a lower interest rate than what fixed rates do. Well, the times where you will save money with a fixed rate is when that inverts and you can get a lower price fixed rate than a variable rate. And oftentimes when you can get a lower price fixed rate, it's better to take a 1 or 2 year fixed rather than a 5-year fixed so that you can still kind of have a little bit of a variable rate strategy, but also take advantage of the lower rates at the time. Now, it doesn't matter which direction interest rates are going, variable rates will still outperform fixed rates. And the reason why is because interest rates fluctuate. And when you have a variable rate, you don't only feel the pain when interest rates go up, but you also get the added benefit when interest rates do go down. And what central banks have a tendency to do is overshoot. When they raise interest rates, they often raise them too much, meaning they have to bring them back down. And that fluctuation in interest rates is what ends up making it so that variable rates outperform their fixed rate counterparts. Now, also think about the fact that let's say you are borrowing at 1.5% on a variable rate and the going rate for a 5-year fixed is 2%. So you've got a 0.5% lower variable rate mortgage. Well, think about this, okay? Let's say you get that 0.5% discount for the next 2 years. And then the Bank of Canada starts increasing interest rates. Well, they would have to increase the interest rate by 0.5% for you to be even. That's what most people think, but that's not exactly true because it isn't 0.5% that they have to increase the rates by for you to be even. Because you've had all that time where you've had a 0.5% lower interest rate than you would have on a 5-year fixed. So in reality, you would actually have to have the Bank of Canada increase the interest rates another 0.5% over and above that original 0.5% increase, so by 1% total, in order for you to be break even. Now, the chances of interest rates going up by 1% in a 5-year period when interest rates are this low is slim to none. Now, the other thing to note about variable versus fixed rates and the long-term prospects for variable rates is that you shouldn't be taking a 5-year fix thinking that interest rates have nowhere to go but up. Because the reality of it is when interest rates are as low as they are right now, which is near zero, it takes a very long time for interest rates to increase. Now, I'll point to 1935 to 1970, where it took interest rates 35 years to increase from 2.5% to 7.5%. So 35 years to increase 5%. And I'll also point to Japan in the early 1990s that when they started their 0% interest rate policy, they did not expect that it would take 30 years for them to get to the point where they could start increasing interest rates. And that's where they're at right now. They've had almost 30 years of low interest rates. So for the majority of borrowers who are getting a mortgage in 2021, there is a very high likelihood that your mortgage will almost be paid off before interest rates go up substantially. Meaning that a variable rate strategy is going to be a far better strategy than what a fixed rate strategy will be over the next 25 to 30 years. Okay, and the third and final reason why variable rates are safer than fixed rates is because of penalties. Penalties are the single biggest banking fee you will ever pay in your lifetime. And most people, when they're getting a mortgage, are thinking about wanting to save 0.1 or 0.2%, which is the equivalent of saving $200 or $300 a year, and not realizing that the single biggest expense you will have on your mortgage is, in all likelihood, not the interest rate, but the penalty. Because here's the reality of life. Life is variable, just like your mortgage should be. And when you see things happen like people end up losing their jobs, or marriages dissolve, or you have kids and you need a bigger house or something like that, maybe you get transferred from one location to another. Well, the reality is most people in their lifetime are going to see some sort of penalty on their mortgage. And unfortunately, if you've got a fixed rate mortgage, that penalty is going to be high, probably in the $15,000 to $20,000 range. And if things go wrong, let's say you do need to sell your property to get some of your equity out, well, you're already going to be paying a realtor 3 to 4% of the value of your property, maybe more. And if you've got to give 4 or 5% of the value of your property to your bank as a penalty, well, that decision to take the safer, more reliable fixed rate mortgage ends up being a bad decision, and what was ultimately a very risky decision because you didn't realize the penalty was the biggest risk associated with that mortgage and with losing the equity in your property. The other thing people don't realize is that when you've got a variable rate, you've got the flexibility to pay a 3-month interest penalty and also lower your interest rate. So as discounts get bigger and you get the opportunity to save money, having that low penalty allows you the flexibility to take advantage of lower interest rates and basically mortgage planning that allows you to pay off your mortgage sooner, ultimately saving you tens of thousands, if not hundreds of thousands of dollars over the life of your mortgage. So here's the reality of it, is the biggest danger in a mortgage in Canada is having to pay a penalty, especially a big bank penalty. And we don't understand why more people don't know this, but the reason we make videos like this, where we talk about why variable rates are significantly safer than fixed rates, is because that penalty risk is the single biggest reason why a variable rate mortgage is safer. And for my wife and I, we've known this. We're in the industry. Most people in the industry will only take variable rate mortgages. They'll rarely take fixed rate mortgages because fixed rate mortgages, like I said in the beginning, even though they seem like they are a safer alternative to a variable rate mortgage because the payment's going to be the same, in Canada, the reality is they are just long-term adjustable rate mortgages that come with very high penalties and often a premium and a higher rate that you have to pay for that total 5-year period. So take it from me, variable rates are the safer alternative to fixed rate mortgages. It may not seem like it, but do your research, and I'm sure you will find that over time, your variable rate mortgage will not only outperform your fixed rate mortgage, but will give you a lot more added safety and security when it comes to your finances. If you enjoyed this video, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video, and leave me your questions and comments. What do you think? Does a variable rate seem safer now that you know all the ins and outs, or are you still a fixed rate borrower?